There we go. No?
All right. So the fun thing about this is we're live now on YouTube. It's something that I started doing last week. And so my hope is that we'll build quite the channel where we can get all these videos. And if it's something that's interesting, you'll be able to go back to it. And the purpose of these classes is to be generally one topic, one main topic. And if it's interesting to you, it's quick, it's in and out. And if it's not interesting, then you can just not pay attention to it. So hopefully that will help in as far as like, we do this a lot of, we'll have videos going back on many topics. Today's topic, I think, is kind of an interesting one. We're about 30 days, a little more than 30 days away from the storm back in September. And there's a lot that's happened. We've done a lot of classes on the different things. If you need my help on that stuff and you didn't know what we've already talked about, feel free to reach out and I can show you some of the other videos too. But in regards to these storm damaged properties, first thing I want to talk about is insurance. So insurance is still a bit of an issue. It's higher than it was, but that was kind of going in that direction anyways. So I always like to say that anyone that is doing a deal right now, they just have to advise their client to call insurance up in advance. Kent, historically, realtors would always say, call your lender. That's the first thing to do. And now it's kind of like lender is 1A and insurance is 1B. What are you seeing? Are you hearing anything different to that? What kind of is the sticking points for you after all this?
Yeah, insurance is a big deal right now, especially after the storm. I mean, first it was everything has to be re-inspected, right? Even if you had insurance going in. Now it's difficult even to write insurance, especially in Lee County. And then third is, and now we got to deal with flood insurance. Are you even going to be able to get it? So insurance is a big deal. I've always in the past, when I do pre-approvals, estimate insurance, but it's really difficult. So now I'm really trying to get an actual quote from different insurance companies. You should have a multitude of insurance companies and contacts that you know. I try to use local companies that I know and have done business with in the past. But insurance is a big deal because it will drastically change from property to property based upon condition, roof, age. There's so many things that will go into what that insurance quote might look like. And it's a big deal. For sure.
So you and I had a deal, Kent, where the home needed a new roof, right?
Yep.
What was the sticking points on that one in regards to insurance and then the loan? Do you remember anything?
So the appraisal came in subject to because there was damage from the storm, which is fine. The advantage to the customer actually was if they got the new roof, their insurance was $2,000 a year less. So it was a better deal for them to do that anyway, and also helped qualify.
Yeah.
So, as long as they can get a reasonable quote on a roof and get it done in a reasonable amount of time, which obviously roofers are extremely busy right now, it was actually a really good deal for the borrower.
Yeah, I love that. And so I've got another deal that I'm working on right now. And the buyer's kind of gone through 3 different properties trying to find the right fit. And we thought we had nailed it on this one, but there was one big problem on this, and that was that the pool area had lost its screen and the enclosure. And so the lender or the insurance required that a gate be put up. I think, they had to make sure that it was a certain protection from not only inside the house, but also any neighbors. So, pools are considered an attractive nuisance. And so the insurance company is a little freaked out and they're like, you need to have a 4-foot gate around the whole property or around the whole pool area. And then the county also had a say in what they required for permitting and local building codes. And then the HOA had, to give their peace of mind as well. They had their own requirements, and collectively, it was not only shooting up the cost of their insurance, but it was also making binding insurance nearly impossible. And so, the hard part with that deal is, even if you were paying cash, unless you're willing to close without insurance, That's a hard deal to push through, and the contract doesn't really do a great job of protecting the buyers if insurance is unavailable, especially on cash deals. So be very careful. In fact, it might be a good example is to either put it as a financing contingency deal where you have those protections. You know, if Kent says, hey, you need this roof fixed or you need this pool to be enclosed, then you can go to the seller and say, look, I can't get my loan. They're going to deny me if we don't do this stuff. But if you don't have that financing contingency, then whatever Kent says isn't going to be very helpful. You know, you don't have a leg to stand on because like, well, it's a cash deal. You know, we don't have those requirements on this one, even though it's very real. So I think the key on that one is don't assume anything. Don't jump to conclusions. And before you go under contract, it's probably a really good idea to talk to someone like Kent, but also talk to an insurance broker and just kind of get the feel for it ahead of putting an offer down. And then separately, the contract you use matters. So if it's an as-is contract versus a standard, that matters. You know, a standard contract, you're not going to be able to back out just because you can't get insurance. An as-is contract, you can back out for any reason. So it's, I think more and more, I would push buyers to use an as-is contract right now just for that purpose. And then NABOR versus FR matters as well. If you're using a standard contract in NABOR and you haven't put any deposits down, but you're under contract, you know, if you just walk away and say, look, I'm sorry, the insurance is going to be a problem for me. If you haven't put any money down, you really don't have any risk. There's no exposure to you. But in a FR contract, the seller's remedies are any deposits that were made or agreed to be made. So that can be really, really tricky. I have an example right now where they're having trouble with insurance. It's a FR standard contract. For many reasons, that was the buyer's preference and the seller's preference as well. But now that they're having trouble getting the insurance, even though they've only put down the first deposit, which was like $5,000, the buyer's technically going to be liable for the full both deposits. I think it was another $50,000 that was going to be due, because FR, remember, says any deposits that were made or agreed to be made are seller's remedies in a buyer default. So I wanted to kind of go down that rabbit hole just a little bit further. So I'm going to pull up a FR contract. I'll delete that. So this is NABOR. This is my FR interface. Actually, let me share my screen. You guys can all see it. All right, so we're going to go to FR because I have to change my password. And we're just going to go to a standard contract. Remember, your whole setup might look very different from mine, so don't overthink it. It's called appraisal as is. I use an as is. You could use an as is, but I'm trying to see what my main contract is called. Sale, seller finance, and short sale of residential. Here it is. I'm sorry. Here we go. All right, and remember, guys, this is a little different format. So if you want to speak up, just raise your hand or put something in the chat feature, and I'll unmute you and kind of welcome you into the fold here. So in this one, this is our FR contract. We have deposits, and I want to keep going down. So what we're looking for is whether I can protect a buyer who's made one deposit, but maybe not the second, and now is realizing they're going to have real problems, not only getting reasonable insurance, but getting any insurance whatsoever. So my first example would be, to select this second box. This contract is contingent upon the mortgage, right? And Kent, have you denied people due to insurance issues before? Does that sound right?
Absolutely.
Yeah, so it could be any number of reasons. It could be that insurance isn't available. It could be that insurance pushes you over your debt to income ratio, anything of that nature. Is there any other restrictions on insurance that a lender would look for, Kent?
It's going to be, stuff that might affect livability, but the biggest thing is cost. If cost changes and it shoots them their DTI too high or something like that,
Oh, yeah.
or there's an inspection done on the roof and it doesn't have the certain straps that they were supposed to have, or whatever the case may be, and it makes the quote go up.
Yeah, exactly. And insurance is a little fickle. One insurance company might have a restriction that another one doesn't. So I wouldn't
Yeah.
rely entirely on one company. I would probably spread the love and see, make sure that your client reaches out to multiple parties. So we have
Absolutely.
that insurance, but let's say we have this financing contingency. Let's say that kind of isn't what you're wanting and you're competing for the offer. You call your insurance company in advance, or we could put something in the special terms or do an addendum. So if we scroll all the way to the bottom, and I'd be happy to give anyone language that needs something like this. So we could say agreement is contingent on buyer getting insurance for the property. And then you could leave it at that, or you could add on more. You could say with a premium not to exceed $5,000.
That was going to be my question, Kristen, whether you put some sort of a dollar amount in there for
Yeah,
sure.
so it's a great question because the deal that I did recently, when we put in this type of language and it had a limit, so buyer shall be able to bind insurance, not to exceed $10,000. That number freaked the seller out. It totally freaked the seller out, and it ended up sabotaging the deal. So what you could have done instead is you could have just left it at that. Agreement is contingent upon buyer binding insurance prior to closing, or being able to bind insurance for the property prior to closing, including flood insurance, wind insurance, and hazard. In the event buyer not bind that insurance, buyer may terminate its deposits in full. That's what I would give you. And so just reach out to me. You don't have to copy this language, but if you wanted to, you could. Obviously, I spelled some things wrong because I'm trying to run through it real quickly. But that's what we would do. It's a little thing of like, hey, I'm not getting a mortgage. I don't need a finance contingency. The only thing I'm worried about is insurance. And it could be insurance being really expensive. It could be that we find out there's something wrong with the roof that makes getting insurance impossible. Or in my recent scenario, it was the pool cage and the gate. And so, on a cash deal, that is really causing us some big problems. Because I don't know
So what about the
exactly how to get the
floodplain
buyer out.
changing? What about the floodplain changing, Christian?
Yeah,
That
so we haven't
BFE?
seen that yet, but that'd be a big deal. So Kent is mentioning that, the flood hazard areas might be updated. In fact, they tend to get updated every 5 to 10 years anyways. And so a lot of areas in the Southwest area are due for a flood change update. And basically what that means is that the federal government sets what they believe is the base flood elevation. Below it, you're high risk of being flooded. Above it, you're at low risk being flooded. So, for example, I think my dad is in a base flood elevation of 9 feet where he is. And so the permitting and everything, they want to be at 10, right? So if you're 1 foot above the BFE for your interior space, you're going to be okay. You're not going to be required to get flood insurance, but that's what it is today. It's possible that at some point in the next 6 to 12 months, those BFEs will update. And so now it's not going to be 9 feet BFE, maybe it's 10 or 11. And if that's the case and you're under contract, all of a sudden you have a seller who never needed flood insurance before, doesn't have flood insurance. And mid-cycle, your buyers will be like, wait, now I need flood insurance. And let me ask you, Ken, have you seen, what have you seen generally flood insurance costs? I know it kind of runs the gamut.
It really does. It really they changed those flood, determination areas reasonably often. Not the BFE doesn't change that often, but as far as the zoning does change pretty often. But it can absolutely make a very large difference, especially the closer you get to the water. Yeah, it's a big deal.
It is a big deal. I think you could be anywhere from $500 a year if you're not in a flood zone. You can still get the flood insurance, but then if you are very much in the flood zone, the hazard area, you could be $500 a month, it could be $1,000 a month, or possibly more. And it all depends on, a lot of different factors and what kind of claims have happened in the past. And so it's definitely a tricky part. And what it could end up meaning for some people or for some properties is that some properties may not be salvageable, may not be sellable as, an improved structure. It could just be a land deal. And it's a lot of factors that would lead you to that decision, but it may not be the desire of the buyer or the desire of the seller. It could just be the reality of the facts and circumstances. So it's a little messy. It's a little messy. So I'm going to share my screen again. So this is that force majeure clause. Buyer seller should not be required to exercise or perform any right or obligation under this contract to be liable to each other for damages, so long as performance or non-performance of the right or obligation or the availability of services, insurance, required approval, essential closing is disrupted, delayed, caused, or prevented by a force majeure event. Now, we've spent the last 30 days or more talking about this section. Now, this is a FAR contract, so we're looking at FAR. Here's the question I have for you. Does that force majeure event have to occur during your contract period? Or could it have occurred a month ago, like it does in our case? You went under contract in the middle of October, and now you're realizing that insurance is still a problem. Can you rely on this language? I'm kind of the opinion that you could, but it depends. So we'll look at FAR, and then let's move over and look at NABOR next. But force majeure means hurricanes, floods, extreme weather, acts of God, all these things that they like to scare us to death with. The force majeure event will be deemed to have begun on the first day. The effect of force majeure prevents performance, non-performance, or availability of services. All time periods affected by the force majeure event, including closing date, will be extended a reasonable time up to 7 days after the force majeure event no longer prevents performance under this contract, provided, however, if such event continues to prevent performance under this contract more than 30 days beyond closing date, then either party may terminate. So I hope I'm really trying to make you think creatively and a little bit outside of the box. I don't believe that a force majeure event has to have occurred during the contract. I really don't. It doesn't say that. It doesn't say it had to have happened prior to or during this contract period or after the effective date or anything of that nature. So if you go under contract today and it says, you're one deposit in and you're wondering, how do I get out of this deal? Because now I cannot get insurance. The pool cage won't be fixed. It's going to be a year for that to get fixed or whatever it might be. The roof, we're 2 years away on roof or whatever it is. You now can't get insurance. So you delay, and if it delays closing date by more than 30 days, either party can terminate. This is really tricky. You could hurt some feelings having to go this route. And so you'll want to lean into attorneys. You're going to want to call me or whoever you trust, whoever you work with the most, to kind of guide your buyer or seller this route. Now, alternatively, if you are the seller, let's say you're the listing agent, you're representing your seller, and the buyer reaches out to you and says, hey, we can't get insurance until that roof is replaced. And your first response, a lot of times what I'm seeing, the first response is, it's not a financing deal. Well, I don't care if you can get insurance or not. That's not part of the deal. It is. Under the FAR contract, it is. So I just want you to make sure. The tricky part is if your first response is, no, you're wrong, that doesn't work, and your client that's what you tell your client, that's going to be your client's position, and you're not going to be able to talk them back from it. I find this a lot of times. Ken, I'm curious if you've had this realization on your own front, but once I tell a client something, black and white, or if I give them legal advice, they can't unhear it. And it clouds every decision they make thereafter. Do you get anything like that when you're kind of helping someone through the loan process?
Well, in the loan world, not so much, because insurance is gonna be a requirement on every loan anyway. So it's one of the things that you have an advantage as a buyer because you have more protections when you're getting financing versus when you don't.
Yeah,
It's something
absolutely.
that it's actually a good thing for a buyer. Obviously, it's self-serving for me to be financing, but you actually do have more protections, and we are going to require that it's going to be insured. So it's just one of those things that I don't have to have that conversation about no insurance because we're always going to require it.
I love it. I love it. All right, so now we're looking at the NABOR contract. I'm going to start by showing you standard D. This is disclosures, inspections and remedies, election response, seller maintenance, walkthrough, and risk of loss. So let's use that same scenario. Buyer and seller trying to work through a deal. And first you have to kind of look at these disclosures. Permits and violations. Seller does not know of any improvements to the property which were made without permits or certificates of occupancy / substantial completion of any existing violations of local ordinances or codes, or any pending code enforcement violations or proceedings affecting the property. Just realize that that is in there. That's the standard. So if you've got a property that's been damaged and it hasn't been brought back to code, or it hasn't kind of gone through the permitting process, you're going to want to make sure that you disclose that in your seller disclosure or some other way, either removing this section or updating this section. And so you really want to push and lean on an attorney like myself that could help you through this. Also, number 5, I think, is really interesting: past insurance claims. Sellers are unaware of any past insurance claims on the property which would increase the cost or restrict the availability of insurance coverage for the property. Now, if you have a property that was damaged in the storm, this could be a problem for you because it's in there. And most people don't even realize that that is there. If I was representing a buyer and this section wasn't fixed, and there's an open permit or open insurance claim that's causing me issues with getting new insurance, I'm going to lean to this and say, you misrepresented the facts, Mr. Seller. You defrauded us into getting under contract. Even if that wasn't the intention, this could be a little tricky for a buyer or seller. So now we keep going down, and we're going to look at some more. Again, this has nothing to do with a financing clause in one. And so if we look at 196, insurance availability and costs. Prior to signing this contract, buyer is advised to consult with insurance professionals to ascertain the availability and cost of casualty, wind, or flood insurance, and further that insurance may be required if buyer is financing the purchase. So now that's something the buyer is taking on. The buyer knows that they were supposed to do this prior to signing the contract. So historically, no one did that. That's something that is now we're realizing that's a big deal. So when you go through a contract with a buyer these days, highlight that part and make sure you talk to them. Hey, we talked about mortgage, you don't want to go that route, but we also talked about insurance. Remember, this is in the contract. You're not going to be able to use this to get out of it later. Did you know that was in there, Ken?
Yeah.
Oh, you're so smart. Good job.
All right, I've been doing this 22 years. There's not much I haven't seen.
That's good. Yeah, we talked about this previously, but let's look at this one more time. The FEMA 50% rule. Buyers advise that if buyer intends to make substantial improvements to the real property, buyer's changes may be subject to FEMA regulations, limiting improvements to 50% of the value of the existing structure. The class we did last week talked about this length, so I won't go too much into it. But this is another disclosure that the buyer is accepting by going under contract. So just make sure that this is something that you hit. Hey, look, house was destroyed by the storm. Have you already talked with the county about it? Do you have a plan for this? Do you realize that if you can't bring it back, you might still be obligated under the contract? So then we have our inspection language, defective items. The key on defective items, it's kind of interesting. So not everything is a defect, but if it is, like let's say the roof is leaking, even though you don't have a financing contingency, the roof leaking or being not correct could cause you issues with your insurance. And then you could lean to it and say, look, seller, I need you to fix the roof that's leaking. But there's a tricky part on this. The scope of buyer's election shall not include or extend to any item for which seller has no maintenance, repair, or replacement obligation under the governing documents of the condo or homeowners association. Except for buyer's permanent election, buyer shall be entitled to one buyer election. Let's see, there's something else in here. No, oh, this is another one. Nothing in this paragraph shall extend the closing date. So let's say you find that the roof is leaking. You make your buyer election, seller agrees to fix the roof, but it's not going to happen prior to closing. And so this section here says it's not going to extend your closing date, even if the seller agreed to fix the roof. It's just going to be pushed into an escrow potentially. And so then
unless you're financing, Christian, then I'm sorry to interrupt. If you're financing, that probably will need to be done before closing.
Yeah, it would be, especially if it's a roof. A roof, foundational issues, kind of the big ones, the lender's going to really care about. If it's a tiny ticky-tack thing, the lender's probably not going to care that much about. They don't like escrow agreements, but they, it just depends.
It depends, right?
Yeah, thanks, man. That's great. So some of these things will help you, some of these things will not. This section C here is about the maintenance obligation in the event that the seller doesn't maintain the property correctly. It's still an escrow. They don't have to, it doesn't delay your closing. This part is the interesting part. This is one I wanted to compare with FAR. So risk of loss, casualty, insurance, all these things. Any loss or damage to the property or personal property caused by fire, flood, extreme weather, other casualty occurring between the effective date and the closing date or date of possession, whichever is earlier, shall be at seller's sole risk and expense. Seller shall maintain all existing insurance until disbursement. That's very different from FAR. That's very different. So let's look at this next section. If as a result of the casualty, buyer is unable to obtain insurance or is unable to obtain such insurance at a reasonable rate, and or services essential for closing are not available by closing date as a result of the casualty. Buyer may delay closing until the date is up to 5 days after said coverage becomes available, not to exceed 30 days. And then there's a time period where buyer and seller can terminate. Here's the question, and I don't know what the answer is. Does this casualty have to have occurred between the effective date and closing date or a possession date? It says that in the first section, but then it doesn't really reference that in the later sections. I don't know. That's
questions on that. I have 2 questions on that, Christian.
Go ahead.
Number 1, was there a seller's disclosure? Number 2, who determines reasonable rate?
Yeah, there is no way to determine reasonable rate. It's something that would get litigated, but the way I've determined it, like when I'm talking to my own clients, either buyer or seller, is if it's at least 50% increase in price, that's not really reasonable. If you're going from a $5,000 policy to a $7,500 policy, I think that's where reasonableness starts going out the window. But in the very least, it just depends. It really does. If it goes up 20%, is that reasonable? I could see you argue that it is, and I could see that you argue that it's not. It really depends. If I had gotten insurance quote before I went under contract and it was 5 and then ended up being 14, that's not reasonable. I can't imagine someone would argue with me on that one, but they would try. They would certainly try. This is very interesting, and I think ultimately the key is I don't want you guys to get caught having to advise a client how to get out of the deal when it could have been determined ahead of time. Because it has disclosures, it has ways that they're supposed to be pushing, they're supposed to know this ahead of time. Buyers acknowledging certain things, sellers making other disclosures. And I think that leads to my most important point, and Kent, you mentioned it. Where's the seller's disclosure in all of this?
Yep.
Where's the seller's disclosure in all this? Very important. Do get a seller's disclosure now more than ever. Disclose. And the more conversation the clients have, the buyer and seller and agents have about these items, the less there'll be an issue as things go forward. And the way I always learned about this was not some big checklist. I called it, instead of calling it a due diligence checklist, I always called it a don't do that again checklist. And I might have thrown a couple of expletives in there too. So don't do that again checklist. Learn through my clients and what other people are seeing, and try and advise your client ahead of time. Try and get in front of this stuff. And if the house is not sellable in its current condition, if it's not something that we can salvage due to any number of reasons, then make sure that's disclosed. Make sure that's disclosed. Deborah, you raised your hand. I'm excited.
Thank you. So in all of these contracts, my question is there a paragraph that says if while you're in the process of purchasing, all of a sudden the house has X amount of percentage of damage that the buyer can back out of the contract? Any of these? That's the way it was in New Jersey.
Right. Well, it doesn't give you a percentage.
Okay.
And it also, as we just talked about in the NABOR contract, at least, it's not very clear as to whether that damage had to be done during the contract period or before. So it's very tricky. I mean, ultimately, the risk of loss is on the seller, but if it exceeds a certain amount and it takes so long to get these things fixed, there's going to be ways to get out of these contracts eventually. Were you thinking, Deborah, like if you went under contract now, the storm already passed by, but then you realize during your due diligence or afterwards that this is too much, that your clients, bit off more than you can chew? Is that kind of what you're thinking?
Well, if it wasn't something discussed in the seller disclosure, and then you find out that there is structural damage that no one could see that was a result of the storm, I guess it depends which contract, if it says that the buyer, is there a cutoff in any of these contracts that say once it gets to a certain number that the buyer can walk, even if the seller wants to make the remedy? No,
not quite like that. So in Florida, the ruling thought, the precedent is buyer beware, caveat emptor. So it's the buyer's obligation to do their own due diligence and find out as much as they possibly can. And the only exception to that is if the seller knows about something that has real value. Let's say that they are aware that the structure is unsafe and that a buyer couldn't have discovered it on their own. On a non-invasive test, buyer had no way of knowing this. That's when the seller has real liability and you can negotiate getting out of the deal. But it's not automatic, and it's very tricky because in today's world, in our environment, a lot of these sellers, I'm doing a lot of big deals for homes that were maybe before they were too nice to tear down, and now they're ripe to tear down. They're perfect for tear down. And they've asked me, well, what kind of disclosures do we need to make? And you say, you tell them everything. Mm-hmm. If you don't know, you say, I don't know. If you don't know about the foundation, you don't know about the condition. But ultimately, Deborah, it's buyer beware. It's always going to be on the buyer unless the seller hid something intentionally. And it had value, it had real damage.
Okay, thank you.
Yeah, that's a great question. It's a great question. And I think that's also where we can sometimes get ourselves in trouble when the buyer or the parties assume something. They assume it might work a certain way. And then in actuality, it mentions nothing like that. That can be a real challenge because then we're kind of going backwards to try and reverse things. So that can be really challenging, but that's a great one. Bill, I see that you're on there. I don't know if you have the opportunity to talk, but I know Bill is, he's working up in Lee County a lot, Bonita, and he's had his own, some of his clients he's helping that have been on some of these properties, and he's doing with his own stuff. Is there is there anything that you might be able to share with us, Bill, about what people are, how these types of properties are sold and how you're selling them? Because at the end of the day, you're a salesman. I need you to know, I need you to teach me how to sell.
Well, it is a little bit different now with the storm and the storm damage and like you said, the 50% rule, and there's some homes that, you kind of wonder about the mold issue, and how that's going to be dealt with, and if it's going to show up later. I have one now where the tile floor, the owners don't want to take it up, and I'm just wondering what kind of moisture could be under the tile floor, and is that going to be an issue with mold later going down? Because they're going to put it on the market, and all I know is we can disclose that the house did flood and that the original, the tile floor hadn't been replaced. And I'm just kind of wondering what to do about that.
Yeah, it's a tricky situation, Bill. What I would say is if the seller's going to undertake trying to get that answer, then you'll disclose any results that you find. But if the seller really has no idea what's going on underneath the tile, then there's not much you can tell other than what you just said, that the house was flooded. So you kind of have two scenarios. One, just disclose it. House was flooded. Water reached 18 inches inside the home. Whatever you need to do. Here's the things that have been done since. Seller isn't aware of anything beyond this, but I'm sure whatever we could find language that might help. And then there is a Hurricane Ian disclosure that NABOR provided that I'm willing to share as well if it helps. But alternatively, if the seller's like, all right, well, let me just rip the Band-Aid off, let me pull up the floors because it's going to be hard to sell without us knowing what's going on down there. Buyers are not allowed to do invasive testing and all of those things. So in that scenario, you might have a buyer that says, hey, look, I'm really interested in the property, but I need to know what's under the floor too. Would you allow me to do invasive testing? And that is tricky because it sounds reasonable. It sounds like it could benefit everybody, but there's real liability. Who's doing the work? Who has the liability? Is there insurance? Is there not? Are they licensed? It's a rabbit hole. It can be really tricky. So Bill, if you're trying to figure out a solution, and if your seller has questions or wants some legal advice, you just have them reach out to me directly.
Okay, thank you so much.
All right, well, that was a really neat class. I hope that was helpful, and hopefully we'll get more and more familiar with this format. But Kent, I want to thank you for being so good to me, and I hope that everybody reaches out to Kent because he's been a great benefit to me in my practice. I know if you give him a shot, he'll over deliver. So thank you, Ken.
Appreciate it.
All right, guys.